Good morning, everyone.
Good morning.
Morning.
Delightful,
Good morning.
beautiful, snowy morning. Thanks for everyone who drove here. I'm glad you're alive. So we are going to start the morning with a lot of testimony on H66, and then take a new look at the education fund outlook that's been updated, and then do more on H66 with JFO. And then after the floor, we're going to try to finish up H67. And even though sports betting is not on the agenda for this week, would like to finish it up early next week. So if you have anything that you want, reach out at some point. And with that, I think we're gonna get started with you, Abby, if you are there and ready to go. Folks might imagine there are a lot of tax implications to the family medical leave bill. And so Abby's going to talk us through them. Good morning.
Great. Good morning. Just want to check, since I'm using a headset, that everyone can hear me okay.
We can.
Perfect. Great. That'll block out any background noise, which will definitely be happening in a few minutes.
If anything does happen, we will all roll with it. It's okay.
Okay. Thank you.
Yes.
So I'm just perusing the website just to make sure you can all follow along. So my understanding is I will not share from Zoom. So my testimony is a memo that's posted under my name for today's date.
Thank you. Yes.
And so this is relating to a couple of different areas of tax law. The way that H66, the paid family and medical leave bill, as it came out of the report from House General, how that would impact both employees and employers, and how it works for self-employed, both focusing on income tax consequences and, at least for the employees, the homestead property tax credit. So this is a pretty dense memo, and I'm happy to pause at any point and take questions. And because this has so many different aspects, I might not be able to answer all of your questions, but I'd be happy to think through those and get back to you. And it might take a few sort of back and forth for us to get through all of your questions. And this is written out in memo form, so I apologize if the sentences are a little dense. I'd also be happy to provide something in more like bullet points or another format if that's easier to absorb. So I did focus on income tax. That's the primary area, but I did want to point out the way that the property tax credit would likely be impacted by this. So to lay out the sort of where income tax comes into H66, employers and their employees would be required to pay equal shares when they're contributing into the insurance program. The way that the bill and the new report from House General is drafted, those contributions would be deducted. So for employees, they would come out of their wages, just like income tax is withheld. There is specific language that makes it very clear that all of the administrative provisions that apply to withholding, those would all apply to the contributions for this leave program. Self-employed individuals would contribute. They would have the option to contribute to the program, and they would pay through estimated installment payments, and all of the income tax estimated payment provisions would apply. So again, that gives all of the administrative authority that the Department of Taxes has. That would apply to this leave program as well. Employers do have an option to opt out if they provide benefits through a private plan that are equal to or more generous than the state plan. That in itself doesn't really have much of an impact on the tax consequences. It's just that they then wouldn't be subject to withholding and the other requirements. So that is the basic overlay of what I'll be diving into. So there's both the contribution side and then the benefit side. So starting first with contributions, split it into how employees would be treated and then the impacts for employers. and when I'm saying employees, actually, I focus primarily on employees, but this would also apply to self-employed. I didn't make that as explicit in this example. Self-employed would be able to either take a deduction depending on whether they itemize, or they would have the same tax treatment as employees. So let me dive into that now. So employees, when they contribute to the insurance program, that would be treated at the federal level as a payment of a state income tax. That's because the way this is drafted, it's a mandatory payment. So contributions to because it's mandatory, it's treated like a tax. So contributions to the Family and Medical Leave Insurance Program would be deductible on an employee's federal income as a state and local tax, but that only applies to individuals who itemize. And then I've added here, as we have discussed, since 2018, the Tax Cuts and Jobs Act enacted a cap. So for individuals who itemize and take the state and local tax deduction, they can only claim up to $10,000 in state and local taxes, or $5,000 for married filing separately. So individuals who through the end of 2025, it is set to expire at that point, but individuals would only be able to claim up to $10,000.
Go ahead, Representative.
Thank you. If we were still piggybacking, what would they be able to deduct instead of being just not piggybacking on all the federal provisions?
Deductions. I hadn't contemplated that because we don't. None of the itemized deductions flow through anymore, except for the medical deduction. So this is only looking at the federal level. So there is no Vermont deduction for state and local taxes paid.
Thank you.
Would you like me to look at the prior law? To be honest, I haven't looked at it since it was repealed, so I don't remember. I think it was a $5,000.
Representative Odie, are you wondering if the federal law was different, what would happen?
I'm wondering if we had not stopped piggybacking, if employees would be better benefited. And I would like to know the other answer.
So we don't, again, because we don't have a state and local itemized, we don't piggyback on that as it is. If we had, my recollection is that it was a $5,000 cap, but I will need to check that.
Thank you.
I'll get back to you.
Yeah.
I think to help with that, I think there are actually a lot of Vermonters now who can't deduct anything because, those who don't have a mortgage, people older than 50 a lot of times don't have a mortgage anymore, so they can't deduct any interest. And that is a big chunk of it was something like 28,000, 27,000. That figure sticks in my mind, that you used to be able to deduct. And I might not be right on that. I might be thinking of something else, but I know that now people rarely come close to it, even with medical expense.
So with the Tax Cuts and Jobs Act changes, most taxpayers shifted to using the standard deduction because it was doubled. So federally, most Vermonters are probably using the standard deduction. I don't know about the numbers on that. I think JFO would probably have that information, or the tax department. So for individuals who use the standard deduction, they can't use this up to $10,000 state and local at the federal level. So there would be a different treatment for those employees who are contributing. And their employer is paying half. There's a different treatment of their contributions than itemized deduction filers. So let me move on to that. When a taxpayer is taking the standard deduction and they're not itemizing, they're only taxed on the amount that their employer is paying in. So their benefit that their contribution they're paying in to eventually take as a benefit, that portion would not be taxed. And under H66, it's half and half. So half of the contribution would be taxable because it would be paid by the employer, and that would be considered like wages. And then the other half would not be taxable because that's their own contribution. So that said, individuals who itemize would be, that would all be post-tax. They would all be paying that contributing post-tax because they would have to claim all of that as income and then they could take the deduction.
Okay, thank you.
Okay, so that's the logic there. Looking at when the employer is paying, that portioning of the contributions, there is a difference for when the employer pays and when the employee pays, but only when it's a standard deduction employee or taxpayer. So that also means that when employees are filling out W-4s or whatever form it is that will be used to determine how much to contribute, given this federal tax treatment and the way that flows through to Vermont, there will need to be some sort of box or indication for employers to know how much income tax to withhold. So that will add an additional layer of complexity when filling out a W-4 or the form to reduce wages by the contribution. Okay.
Thank you.
Yes, thank you. Sorry, it is hard to see your faces.
I know, I appreciate, and I appreciate the pause, and I appreciate that I will sort of help you through the pause if.
Thank you.
Okay.
Hand gestures are useful too, because I can see your hands moving.
Great.
Thank you. So that is so I did not get into the details for self-employed, but given that they would be paying all of their contributions, it's likely that all of those would be considered non-taxable unless that self-employed individual is claiming the itemized deduction, in which case they would have to have all of that be subject to tax. Does that make sense? So that they could, because you have to be claiming all of that as income to be able to then take a deduction against it. So then
That's great.
Okay, thank you. The other, there are two notes in here about the property tax credit. So for income sensitivity purposes, household income does have a broad definition to calculate the amount of property tax credit. That definition starts with federal adjusted gross income, and then there's a long list of subtractions and additions. There are no exclusions that would apply and be obvious that seem to have any sort of statutory basis to exclude these type of contributions from an individual's property tax credit. So likely contributions would count as household income unless you were to decide that there needed to be some sort of exclusion.
And so, Abby, that's the employer side of the contribution.
Correct. Yes, I'm sorry. I should have made that.
Would be considered part of income for property. So like at the most, we're talking about.
As I'm saying this, I'm thinking it just got more complicated as for individuals who are claiming they're taking itemized deductions, they're saying all of these contributions should be treated like wages. So then they're taking the deduction against as much as they can up to that $10,000 cap. For the household income, there is also the treatment for employees who are only paying half and are taking the standard deduction. So they're only paying having tax withheld on the employer contribution. It's actually not totally clear to me how that would work for household income, if the full contributions would be included in household income, or if it would depend whether or not they itemized. I don't think current laws really gets at that. It says sorry.
Sorry,
Yes.
I don't think I understand why a person's individual contribution towards a premium would count as income. I understand why the employer's payment on behalf of an employee would count as income, but I can't imagine why an employee's contribution would count as income, because it's.
If in the case where they're itemizing and they're including it in federal AGI, I think it could be considered their household income because it starts with federal AGI. Because the employee who itemizes would have to claim all of the contribution in order to take the itemized deduction. So that might need, I realize that is not in the bill currently as drafted, but that might need some clarification. And then it's also an issue for benefits, which are clearly included in household income. when actually drawing down on the insurance program.
Can you note that that piece needs clarification for
Yes.
markup? Thank you. Representative Anthony?
Thank you. Abby, it came up earlier for sole proprietorships, the meaning of income in this context and the application of the tax would be net income, that is to say, after the exercise of Schedule C. Am I not right?
I would need to look into that. I'm sorry, I'm not great with the forms. I always have to actually look at them to know which.
Yeah.
Can you say that again?
Sole proprietorship, you're taxed essentially on net income.
Mm-hmm.
It's on the federal form. So I just want to be sure what calculation one would do to calculate the tax owed under this legislation. Thanks.
So you're asking whether it would be a net or gross, the contributions? Correct. Okay. Let me think through
For sole proprietor, LLC, sole proprietor, pass through, any of those has a calculation between net and gross.
Okay, I will clarify that.
Thanks.
Back to you. In terms of the employers, the way that contributions can be treated for employers in terms of their income tax liability, because it's a mandatory contribution, it would likely be deductible as a state tax at the federal level. So it would either be characterized as unemployment compensation or non-taxable disability-based compensation. In any case, it would be treated as a state and local tax. And getting, again, at the Tax Cuts and Jobs Act, $10,000 cap, if you remember, that only applies to individuals. So depending on how that employer is structured, they could take up to $10,000 and be capped there if they're an individual employer. However, if they are a corporation or business, then they would be able to take the full deduction for state and local taxes.
Maybe you said this, I was distracted briefly. But they would also, at the state level, businesses, they would expense that contribution, and that would reduce the tax liability of all businesses in the state, right?
So it would go, yeah, so it would be the net. So again, depending on their structure, which tax they're paying, corporate or personal income, it would be a deductible expense.
Okay, back to you.
Okay. So the next portion, so I'm moving on from contributions and now looking at the actual benefits when they're taken from the program, when an employee is actually claiming benefits, how that would be treated for income tax purposes. And this is where it does get even more complex and fun. Each different bucket has a different interesting treatment. So there has been some IRS guidance. There are multiple states that have come out with similar programs. They're each sort of structured differently, but the general rule is that the income tax treatment depends on whether the leave is or the benefits are characterized as unemployment compensation or disability-based compensation. Unemployment compensation, or UI, is taxable for the individual who receives it, whereas disability-based compensation, like workers' compensation, is not taxable. If a benefit is received for the individual person who's claiming it, if it's received for their own serious health condition, it's non-taxable. That would fall into the sort of disability benefit bucket. If the benefit's being paid with employer contributions, either through a pre-tax salary reduction, so wage withholding, or if it's post-tax withholding, the IRS states that it would be considered as unemployment compensation. So then it would be taxable for the employee. So that's where you get into parsing again between the employer contribution and the employee's contribution and how those benefits would be taxed or not taxed. And I would defer to Damien on the different types of leaves So whether it's for the care of a family member or individual's own serious health condition, depending on the purpose of the benefit, the tax treatment could change. So I'll pause there and then launch into the household income. I think the benefit side of the household income issues are a little bit clearer than the contribution side. Are there any questions on the receipt of benefits and how that would be treated for income tax purposes? Again, this is federally, but that would flow through to Vermont because of the way we piggyback and start with adjusted gross income.
Doesn't seem to be any, thank you.
Okay, great.
Oh,
I
wait,
think
no, there is, sorry.
Sorry. Yes.
I mean, just so you know, Madam Speaker, it'll take me working through this 2 or 3 times before I really feel solid in my understanding of it. So because I ask no questions doesn't mean I've got it.
Absolutely. And I think Abby said at the beginning that she'd written quite a dense memo for us. So I don't know if maybe a table would be easier to, on our brains to process.
Yeah.
Sure.
If that's okay, Abby, that would be great.
Every time I write it, I understand it better. So it's good. It's like taking notes in college classes. Like you just keep repeating it and then it sinks in eventually. And noticing other.
Oh, sorry, go ahead.
Do we
No,
have
just
the dense memo?
noticing.
Do we have the dense memo?
Yeah, it's on the website under Abby's name.
That's the 2 pages?
Yeah.
Okay. That doesn't.
Yes. So I'd be happy to make a chart and sort of the different, if this, then that, sort of consequences. And I have been working with Damian Leonard on this because it's also, there are some other tax questions that we're still sort of parsing through in terms of employment tax implications as well. So
And
for,
so when we're talking, I just want to sort of get us bless you, to sort of scale the conversation a little bit. When we're talking about the tax implications of the benefits of the premium payments paid in or the payroll taxes paid in, the tax implications of, $100 or $200 a year is quite low, right? The tax implications of that being included as part of income. It's what the tax implications of the benefits paid out are, that's quite substantial in someone's life, but
right.
$200 is a very sort of different thing.
Perhaps this is a Craig Bolio comment, I guess. I can imagine it being somewhat daunting for employers to figure out whether the benefit is compensation for an injury and therefore not taxable, as opposed to, as in one case it ends up in a W-2, in the other case it doesn't.
Well, I think Abby just said that she would defer to Damian on explaining that, right, Abby?
Well, I have 2 thoughts on that.
Okay.
So the payment of the benefits would be coming from the state. So the employer would not have to worry about that. So that would be reported probably on I think it's a 1099G or miscellaneous, one of the 1099s as payment. So that would remove that concern about withholding on the benefit side. So that's really one thought. Sorry, that's not 2 thoughts.
Yeah, thank you.
I think my second thought's maybe more on the contribution side when it's the employer that's withholding, to know what amount to withhold income tax from is where it gets a little more complex and would need, yes, I would defer to the department to explain how that would be administered to determine which portion would be subject to tax, because that would need some feedback from the employee, whether they're itemizing or not. So I would defer to the administrative expert.
So Abby, I want to make sure that I'm locking this down. So it would be up to the state to decide if the compensation was due to an injury, for example, or like safe leave, which would be a different tax implication. Am I getting that correct?
That's my understanding based on how the federal tax treatment from IRS guidance sort of lands for the different types of benefits taken. So
Okay,
one would be treated as taxable and one would not.
Back to you.
Thank you. So for the treatment of benefits for determining household income to calculate the homestead property tax credit, otherwise known as income sensitivity. Again, that definition starts with federal adjusted gross income and then lots of subtractions and additions. There is no subtraction that would apply to these types of benefits. There's actually an explicit addition if it's not already included in federal AGI for cash benefits and public assistance, which this would likely fall under. So the benefits received for leave would almost certainly be included in household income. And that concludes this very dense memo, which I'm happy to break into a neater little chart, which might tease out some other questions and answers, hopefully, as well.
Abby, actually, forget it. I don't know that question. I answered it myself. Representative Demmer.
This is really maybe more question for you, Madam Chair. Are we going to have JFO in the to sort of model what this
Yes.
might look like?
JFO is going to come in with all of their modeling of everything this afternoon.
Okay, wonderful.
That is the schedule right now. Yes.
That's all from me.
So wanted everyone to sort of get their heads around all of the ideas and levers and decision points, and then we will have and sort of thoughts behind this, and then JFO will come in and talk through what the number implications are of those decision points. And then we can make the decisions that are still left to be made, and then JFO will come in again with sort of the final conclusions of those decisions. Other questions for Abby? Okay.
Not right now.
Great. Thank you, Abby.
Great, thank you. And feel free to reach out if there's anything in the memo that you had a question about.
Okay, great.
Thank you.
Craig is on his way over. So we're going to take a 10-minute